Okay. Did you do question one, two, or did you do three and four? Maybe. I know I asked you to do one and two from the other exam. But
Yes, I did was I did the other exam one and two, and I did this question again.
okay, perfect. Okay, what's the
Going to.
question?
So on capital allowances,
Yes.
right? When they buy an asset,
Yeah.
okay, why did we not, how do I put it? When you claim the 20% on an old machine,
Yes.
right? Why don't we use the months?
Oh, because legislation says you can claim the full amount. So if you go have a look at yeah, so pro rata would apply to accounting, but SARS, they actually give you the benefit of the doubt. So when you look at the capital allowances, okay, this is seven. Let me open up six. You'll see the capital allowances aren't apportioned. So let's just go back to six. The 20%. You're talking about the 20% here, right? The machine, second hand,
Yes,
this one. Is that the one that you're looking at?
yes.
Okay, so this second hand vehicle, it's section 12C. You can see if you go have a look at the legislation for a movable business, section 12C, apportionment none. Do you see that?
Oh, okay.
Okay, so they don't actually require you to prorata it as long as you've bought the asset. So when we looked at capital allowances, we spoke about government's incentives. So what does government want to do? They want to incentivize businesses to expand, to grow, and to obviously purchase new machinery. Because if they give them these incentives, they would be more likely to grow, expand, and to basically employ more people. So capital allowances is basically like a benefit to get companies converting or changing their assets. Because if you're looking at something like manufacturing, you don't want a business to be too reliant on old equipment. I mean, even think about like you're obviously a pilot, so you're flying an airplane. Obviously, at some point in time, that airplane gets too old, and you obviously don't want to fly it because maybe it's a bit of a higher risk in terms of safety and things like that. So, same with businesses. So, government is saying, well, these items of equipment that's used for manufacturing, we're going to give you 40%, 20%, 20%, 20%, 20%, depending on whether it's new or unused or used, it doesn't matter. But they're basically incentivizing you to buy or upgrade or improve your assets. So hopefully more businesses do that because 40% to claim on, let's say, a machine that's used for manufacturing. I mean, these things could be quite expensive, maybe over a million. And if you're paying over a million and you can claim 400,000, that's a lot. Okay, or if you're claiming 20%, 20%, 20%, so 200,000 each year, that's going to make a big difference in terms of operations. Does that make sense?
Yes.
Okay, yeah. So, yeah, you don't have to apportion it at all. So, when you look at tax, you actually need to forget about your accounting. When you do accounting, I think you are doing more accounting, if I'm not mistaken. If you do those
Yeah.
more advanced levels, the two sixes, the three sevens, so basically accounting second, third, even final year, there's something called deferred tax. I don't know if you've learned about that yet, but this is something that is provided for from an accounting perspective that highlights the differences between the IFRS legislation, so what accountants have to do, and what SARS does. So sometimes you get those differences in tax, and that's basically what a deferred tax is. So you get a deferred tax liability or an asset, but it's very specific, and it's looking at the differences between the SARS legislation. So, for example, SARS doesn't apportion the inverted commas depreciation, but an accountant would. So, in an accountant's financial records, it would be different to the SARS treatment of it. So then that gives rise to that deferred tax adjustment. Did that make any sense?
Yes.
Okay, yeah. So if you've covered deferred tax, you probably have a pretty good idea of that because that's exactly what you're looking at in this situation. Yeah. So forget about accounting when you're doing tax questions. You literally just need to follow the legislation as is. If they say you can claim 40% in the first year because it's a new asset, you just claim the full amount. You don't have to worry about apportioning it because you don't have to apportion it. Sometimes you do,
Okay.
and that would apply to maybe something like the Section 11E, the movable assets, where's it? Um, yeah, here, Section 12E. Okay. Oh, well, this is 12E. This is SBCs. I'm looking for 11E. Where's 11? Here. Is this it? Yeah. Section 11E, normal wear and tear. So here's a schedule of write-offs according to the number of years. All right. So obviously different approaches require different rules, basically, or different assets require different rules.
Okay.
Okay, just something else that you need to remember. You can't claim two allowances on one asset. So if you've got an asset that has already claimed, you've already claimed Section 12C, you can't also claim 11E. So you can't claim two allowances on one asset. Does that make sense?
Yes.
Yeah, because remember there's a recoupment or a scrapping allowance that will arise later on if you sell the asset. Okay, and we'll look at actually a lot of that now when we do the rest of the question. Okay, does that make sense? Are you happy with that?
Yes.
Okay, good. Okay, so let's see how it goes. Maybe in the meantime, later on we can look at what you've done in terms of the May June exam. So if you can, maybe send that to me. I'll obviously download it and then I'll just put it up, and then we can just go through what you've covered just to speed up the process, so we can try cover as much as we can, because you're writing soon actually. Next week will be the last one before your exam because your exam. I think you said that was on the 1st, right? Or the 3rd?
Yes.
What date was it in October?
The first.
It was the 1st. Yeah, so that's Friday next week. Yeah, so you've basically
Yes.
got this week and next week. So it is getting quite close. So you just need to try get through as much as possible. So I want to try cover as much as possible today. So if you can send me what you've done, then I can just go through it, check it as we go, confirm what's correct, and discuss what isn't. And then at least we can try do another two questions to wrap up another past paper. All right, so let's wrap up this one. I'm just going to start a new sheet. I'm just going to call this question 3 and 4. Okay, so obviously we're looking at the rest of the past paper. So this is question 1. Okay, let's go back to question 3. Okay, so question 3 is also out of 25 marks. It's also going to take around about 30 minutes to complete. You've got Best Bricks Company. It's a private company. They're obviously manufacturing bricks in Pretoria North and Polokwane. BBC is not registered, okay, not regarded as a SBC. Okay, so we don't apply SBC. So they're going to get taxed normally, so the 28%, right?
Yes.
Okay, during the year of assessment, the following two transactions related to the assets. Okay, so this is probably CGT because they haven't tested it yet. They have to test it. Okay, this is an important subject, or not subject, topic in the subject. Okay, so when you're looking at any calculation, when looking at CGT, you need to just follow the format. So what are they asking for here? Okay, here they're actually giving you the format, but they're giving it to you in separate steps, which is actually better. So this is a very good question because they've broken it up. Normally, they just give you one bigger question and then ask you, for example, calculate the taxable capital gain. In order to do that, you're going to have to work through the steps. Does that make sense?
Yes.
Okay, so you literally just need the formula. So all I'm going to do is just take the equation or the formula and then obviously we'll just label the answers that we need. Okay, so if it's a longer question, it doesn't matter what type of question it is, long or short, it makes no difference. Where's my format? Here. Calculating CGT. I'm going to copy paste this. That's what you need. Okay, so you write that down. Okay, and then you've got to go line by line by line, and you've got to address the different sections in line with the legislation. Okay, so just to do some revision, when you look at proceeds, proceeds covers this bit. Okay, so to work out your proceeds, you need the adjusted proceeds, which will be applicable for CGT, and then you need to work out the selling price, and you need to subtract the recoupments. Okay, obviously recoupments are specifically included in income. That's why you're removing it. Okay, because remember, when looking at the taxable income calculation, if you're including the recoupment as a special inclusion, you've got to take it out from the adjusted proceeds, because the taxable capital gain can't also have the recoupment, because then you're double accounting for it. Does that make sense?
Yes.
Okay, so you've got the templates, you've got the notes. First things first, get the selling price. Okay, so let's find the selling price in the question. Okay, so, how many assets do we have here actually? We need to check. All right, transaction 1, factory, and then transaction 2, machine. Okay, so you've actually got 2 here. What did they ask for? Factory, 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 machine, machine, and then the total. Okay, so they do want both. Right, so obviously you're going to have to look at each of them separately. So you're going to have 2 of these calculations, basically. Ooh, back to the... Right, so I'm just going to put a label here. This is for the factory. And then you'll have the machine. Okay, then obviously you're going to take the final figure, all right, and if this was part of a longer question, then you would insert that here. Okay, where this block is. Okay, you're going to basically show bracket taxable capital gain of the machine plus taxable capital gain of the factory. Does it make sense?
Yes.
Okay, I'm just trying to show you what they could do. Obviously, they can change the question. They can ask you for this type of working and give you a CGT calculation in it. That's obviously making it a bit more difficult because it's not separate. Okay, obviously you just need to bring in all of those amounts then, including the workings that you're covering here. Okay, so if we go back, all right, the first asset, let's go to the top. Okay, the factory. On 1 December 2017, BBC sold the Pretoria factory. Okay, so we just need to remember what the year end is. Where's the year end? Here, for the 2018 year of assessment. When do they end their year? Do they tell us in the
31st.
question?
Yes, right at the top.
Yes, there, 31st March. Okay, so that's also important to note. All right, because that can apply depending on the situation. And obviously, this is 2018. Okay, so now we know what the year end is. So obviously, if I buy something in December, that's during the year. Do you agree?
Yes.
Okay, so, but when did I buy this? No, I didn't buy this. I sold this. Okay, so I sold this during the year. So obviously, this is going to give rise to CGT, so that's fine. The factory was purchased for 1.2 million on the 1st of September 2001. Okay, you have to look at that date because remember you get before CGT and you get after CGT. Remember that?
Yes.
Okay, so is this pre or post? We need to go look. Where's the date? Where's the slide here? All right. If the asset was purchased before 1st October 2001, was this purchased before 1st October 2001? This was purchased on the 1st of September. September, then October. So this is before CGT. Do you agree?
Yes.
Okay, so now you need to apply this whole part because you need to work out what the actual base cost is, and you need to obviously determine if there is any CGT that's applicable. Okay, so you're also going to need these points. Okay, so A, and then you're going to look at B when doing this calculation. after CGT, before CGT. So that's what I want. Okay, so before CGT is going to be needed to work out the base costs. So I need that. Okay, so there's base costs. I'm going to insert. Okay, paste. All right, I need to work that out. Okay, so there's a working I need to do there. Then I need to also determine what the actual value is by taking these two things into consideration. But I'll only know which one to apply once I've read the question. So let's go back to the question. Okay, so I know this is pre-CGT. The sworn appraiser determined the market value of the factory to be 2 million at 1 October 2001. That's obviously when CGT came into effect. Okay, the sworn appraiser's fee was 3.5. The time apportioned base cost is that. The capital allowances is that. And that's claimed on the factory until the date of the sale. Okay, so they've given you lots of information. Obviously, you're going to apply this. All right, so you've got the market value. Do you have the time apportioned base cost? Yes, you do. Do you have the adjusted proceeds? We'll work that out. Okay, so let's copy paste this. I'm not going to use B because the pre-CGT commencement base cost cannot be determined. It can be determined. Does that make sense?
Yes.
Okay, you have the timed apportioned base cost, so you have to apply it. All right, so that's why I'm using A, not B. But again, it depends on the level of detail in the question. You might have to use it or you might not. It all depends. Okay, it's fine. I'm going to leave it like that. We'll just break it down into its different sections. Okay. All right, so let's go to the question. And let's plug in all the values. Okay, so obviously adjusted proceeds. Maybe I should actually show that as well instead of doing it separately. Let me go get the formula. Okay, copy paste. All right, now we can look at it. Okay, so let's insert values as we read it. Okay, so sold the factory for 4.3 million. So I can insert that here. Okay. Show everything. All right. Even if the recoupment is 0, you're going to show it. Okay. You'll just put 0 there. But stick to the format. Okay. If you stick to the format, you can't really go wrong because you're just looking at each question and seeing what did they give you. Right. We'll check just now if there is a recoupment or if there isn't. Okay. Okay. What else do we know? The factory was purchased for 1.2 million on the 1st of September. Okay. So that was before CGT. Okay. So let's look at the criteria here. All right, so market value. Okay, we've got market value. Time apportioned base cost, we need to insert that. Okay, so in brackets, what is the time apportioned base cost? 1.371527, close brackets. Okay, that's the time apportioned base costs. All right, 20% of adjusted proceeds less allowable costs. Okay, so brackets, 20% of the adjusted proceeds. Okay, we still need to work that out. We can show 4.3 million less recoupments. Okay, close brackets, less allowable costs. All right, do we have allowable costs? We've got the sworn appraiser's fee. Okay, remember when we look at the allowable costs, let me just show you. Was it here? Yes, base costs. Similar to accounting, historical costs, all other costs associated with setup. Okay, that's when you buy the assets. Here, after CGT commencement, costs minus allowable deductions, valuation value plus allowable costs. Okay, so if it's before CGT, they will allow you to include certain costs. Are we going to include the appraiser's fee? Yes or no? What do you think?
Yes.
Okay, good. Right. So I see I haven't put a note about that, but yeah, it'll probably be in the textbook. Okay, but I'm just going to leave this then. All right. So the allowable costs. All right. You can include that. So go back. Why isn't it editing now? Okay, it is editing, but hold on. Oh, there we go. Okay, let's do that again. All right, there we go. Okay, so we've got less. What was the amount? Ooh, I need to go back. Okay, that was 3.5.
Yes.
Okay, if the adjusted proceeds are greater than the market value. Okay, so we need to work that out just now. Let's work out the recoupment. Okay, so obviously the recoupment is going to be the proceeds. Okay, you need to look at whether there was a profit or loss on the sale of the asset. So we need to work out the tax value. Do you agree?
Yes.
Okay, so let's do that calculation. I'm going to go back to the top here. Let's complete it here at the bottom just to show all our workings. Okay, so calculation for the tax value of the assets equals. All right, obviously tax value would be the cost less the capital allowances or allowances. Does that make sense?
Yes.
Okay, so what did we spend? 1.2 million. Okay, the capital allowances are 1.02 million. So the tax value would be
Just a quick question.
Yeah.
If they did not give us the capital allowance,
Then you'd have to work it out, but that would be quite difficult because you don't know if this asset was manufacturing or not. It's a factory, so probably you could assume manufacturing, but we know it's a non-SBC. So if it's a non-SBC, you wouldn't apply the SBC, so you'd apply the normal 12C deductions. Then you'd use the 12C capital allowances.
okay.
Okay, but yeah, they've given it, so you don't have to worry. You can assume it's correct. Okay, don't try recalculate that. Just leave it as is. All right, so 180,000 is the tax value of the asset. Make sense?
Yes.
Okay, how much did you sell the asset for? 4.3 million. Is there a recoupment here? Yes, but it's limited to the previous capital allowances. Do you agree?
Yes.
Okay, so let's work that out. So, what were the proceeds? Proceeds were 4.3 million. Okay, less tax value equals, should I show that? Yeah, let me show it. 4.3 million less tax value of 180,000. Okay, equals, we're going to have to work that out. It'll be what? 4.12. Is that right? Can you check that quick? 4.3 million minus 180,000 should be 4,120,000. Yes? No?
Yes.
Is that right? Eh? Okay.
4
Limited to the previous allowances. Okay. Of what were the previous allowances? 1020123. Does that make sense?
Yes.
Therefore, the recoupment is 1020000. Makes sense?
Can you just go over that again, please?
Okay, so we're working out the recoupment on the asset that was sold. Okay, so keep it simple. If we're looking at the asset, so obviously, I think they even do this in accounting as well. So base costs, tax value, proceeds. So the base costs is what you paid for the assets. So it would have been 1.2 million. Okay, the tax value is 180,000. Okay, the proceeds was 4.3 million. Does that make sense?
Yes.
Okay, so obviously any recoupment would be limited to that. Does that make sense?
Yes.
because then whatever's after that is the taxable capital gain. Okay, this part is the taxable capital gain above base costs. The recoupment is just what SARS is taking back in terms of the allowances, which was the 1.02 million.
Oh, okay.
Can you see that?
Yes.
Okay, so the proceeds minus the tax value gave us a total, almost like a profit on sale. Does that make sense?
Yes.
Okay, but the profit on sale can't be profit on sale because it's not accounting, it's tax. So you have to split it. You have to show the recoupment. So part of it is a recoupment, part of it's a taxable capital gain. Because remember, the taxable capital gain is going to be included in the taxable income calculation. So you can't have the recoupment in the income and then show a recoupment now in the taxable capital gain. That's why you have to take it out. Does it make sense?
Yes.
Okay, so let's take it out. I took it out. All right, so what's the answer going to be? $4,300,000 minus 1,020,000 gives me 3.28 million. Happy with that?
Yes.
Okay, have I looked at everything? Adjusted proceeds? Yes. Okay, there's an answer. Okay, what was that one? That was, okay, adjusted proceeds was C. Okay, so this is the answer for C. Okay. The recoupment is this one. This is the answer for, what number is it? B. Okay. The tax value is this one. Answer for A. Okay, does it make sense? So far, so good.
Yes.
Okay, so tick off factory, recoupment, tax value, proceeds, base cost. We haven't looked at that yet. Okay, so we started with it. We still need to wrap up. Okay, so go back. All right. Ooh, let me just scroll down. Okay, there. Proceeds greater than base cost. It's obviously applicable. Then the valuation is the highest of market value. What was the market value?
2 million.
Yes. Okay. If this is used and adjusted proceeds, okay, what were the adjusted proceeds? We had it earlier, 3.2 million. 2.8 million actually. Yeah, 3.28 million. Okay, so I'm inserting those values. So I'm showing the calculation. Adjusted proceeds was 3.28 million. The market value is 2 million. If this is used and adjusted proceeds is less than, is it less than? No, it's not. Then the valuation value is the adjusted proceeds less allowable deductions. So it does not apply. So this does not apply. Does that make sense?
Yes.
Okay, the adjusted proceeds are not less than. If the adjusted proceeds, 3.28 million, is more than the market value, which it is, then the valuation value is the market value, which is 2 million. Happy with that?
Yes.
Okay, so the valuation value for this asset is 2 million. So you've got 2 million here. Okay, you've got 20% of the adjusted proceeds. I can put that in. The recoupment was, okay, I'm not going to put the whole working. I'm just going to put the value in. 3.28 million. Does that make sense?
Yes.
Okay, so let's work that out separately. On the calculator, 3.8 million times 20% is 760,000 minus 350, not minus, yeah, minus is right. Minus 3,500 gives you 706,500. Okay. All right, so we've got the 20% of the adjusted proceeds. We've got the time debation base costs. All right, so I'm just going to say, therefore, we must use the highest of these three, which is the valuation value. Make sense?
The market value. Yes, okay.
Yeah, market value, valuation value. Yeah, the market value is the valuation value because it
Okay.
was greater than the adjusted proceeds was greater than the market value. Make sense?
Yes.
Okay, so basically, just to summarize what happened here, because this is very complicated, but if you think about it, it's quite logical. Okay, so obviously, before CGT came into effect, remember if you bought an asset, and this actually happened, this was in reality, I don't know, were you born then? Probably, yeah. You're probably older then, 20. Maybe, I don't know. Maybe you're
Yeah.
20. I don't know. 2000, were you born in the 2000s? If you're in first year,
No.
you're probably born after that, 18, 19. So CGT came in after you were born or before?
Mm, after I
After
was
you were
born.
born. Okay, so you were born before. Oh, yeah, because you were
I was
studying all the other stuff.
1999. Anthony, I'm
Yep.
born in 1999.
Born in 1990.
9.
Oh, 1999. Okay, just before the year 2000. Yeah, so you're definitely before. Okay, so let's assume your parents bought a new house when you were born. Okay, because they needed more space because now they've got a little girl in the house. Okay, so back in 1999, if your parents bought a house, that house would have had a cost price. But now, obviously, over 2 years, that house could have increased in value. Okay? And then when CGT came into effect, basically the government said if you bought assets before 1 October 2001, go value your assets. And if you value your assets by a sworn appraiser and the value has increased, they're going to use the 2000, not 2000, the 2 million as the base cost for that asset. Okay, because they're not going to penalize you because they're not going to say, well, we're going to use the base cost, which is 1.2 million when they bought the asset. Does that make sense? Can you see what's
Yes.
happening?
Yes.
Okay, so basically they're giving you an opportunity to, inverted commas, revalue the assets, okay, when you had purchased the asset, but bringing it in line with the legislation. So getting a value on that date. Okay, and then now we're in 2021. Obviously, that house could be worth a lot more. It could be worth maybe what we had here in this question. Okay, this is obviously a factory. Let's say it's worth 4.3 million now. Obviously, based on time, because land increases in value, maybe it's in a good location, whatever the case might be. Okay, now they're going to apply CGT if you sell that property. So if you sell that property now, which we are, okay, they're going to look at this base costs as the base costs. All right, and that's basically what we're looking at here. All right, so let's put in that answer. Okay, my base cost is, okay, I'm going to put a column here just so you can see the numbers. Okay, sorry it's not looking so great because we've got lots of workings here. I'm not gonna wrap text it because it looks funny. I'm gonna keep it as is, just a long thing. Okay, I'm gonna put the base cost in. What was the base cost?
2 million.
Okay, let's use the same, or let's make it bigger. Let's bold it actually. Okay. All right, proceeds we can put in. Okay, happy with that so far?
Yes.
Okay, so there's the total. Proceeds, tick. Base cost, tick. I think that's even one of the answers. Yeah. Okay, so base costs, answer for D. Okay, obviously you're going to have to write down all of this. You can see why you're getting 8 marks, right? Because you had to do all of
Yes.
this. Okay, you must show all of that, eh?
Okay.
Okay.
Do you think it's better for me to write it or to work on Excel
It's totally
for the
up to you. You
exam?
can even just copy paste all of this and then just change things as and when you
Because,
need it.
because the problem comes in when I have to convert it to a PDF.
Yeah, okay. But you can convert this to PDF here. Save as PDF. But then you just have to go to resize the files. Oh, but you could actually just copy this to Word. So
Okay, so which
I don't
better?
know what you prefer. It's up to you. I like using this because I can do calculations, but even afterward, then you can just copy paste this and just paste it into Word, and then take Word and export it to PDF maybe. I don't know.
Okay.
Yeah, either or, whichever works. Or you could just like, depending on your skill set, yeah, I think you can actually set the page layout in that. Yeah, margins,
Okay.
orientation, print area, and then you can just export it as well. Yeah. Okay, you might want to delete some of these extra columns maybe, but you can always fix up the format if you want to. You
Format.
can do that ahead of time. You can just take this,
Yeah.
copy paste it, delete all the stuff, and then just use it as and when you need it.
Okay.
Okay, I'm just using my notes because my notes have all of it. So I'm just copy pasting it here. But I mean, I could have done all of this ahead of time and then just delete and then replace. But yeah, it's easier for me just to copy paste what's in the notes when I'm doing these
Okay.
questions. Yeah. Okay, but yeah, if you're doing this in the exam, definitely try prepare for the actual paper. So give yourselves all, or like create all these templates ahead of time, maybe. Okay.
Okay.
All right, I think we're finished with the factory. No, we're not yet finished with the factory. All right, so the capital gain or loss is E. So obviously answer for E. Make sense?
Yes.
Okay, so what is the capital gain or loss? Proceeds minus base costs equals, there's the answer. Okay, less specific exclusions. Okay, this doesn't apply. There were no exclusions for this because this was a company. Hold on. Let me think about this carefully. Do companies have any exclusions? No, only individuals do. Okay, individuals have exclusions. Okay, so 0 here. So same answer there. Okay, prior year gain or loss. There was no prior year gain or loss. So the net gain or loss. Inclusion rate. Okay, what is the inclusion rate for the company? Do you know it off by heart? We're going to need our Excel stuff.
80%, if I remember correctly.
Is it 80? Do they include
Yeah, and then
80%?
individuals, 40%.
Okay, let's just check it here. If it's not in the budget guide, we're going to have to check in the notes. Yeah, it's not in the budget guide. This is the maximum effective rate. Okay, this is the effective rate, but it's not the inclusion. So I need the inclusion. I don't need the tax. Okay, we're going to have to check that. You're saying it's 80. It's probably right, but let's check. CGT inclusion. I'm just going to type inclusion. Okay. Oops, didn't come up. Okay, let's go with inclusion. Well, let's just go CGT. It should be at the end of the textbook, right? No, this is not the notes. This is the textbook. So CGT, okay, here, CGT, base costs, exclusions. Okay, here, exclusions, but yeah, see, primary residence, this is for individuals, not for businesses. Do you know where the inclusion rates are in your textbook? Have you bookmarked it somewhere?
I don't think I did in textbook.
If it's not in the textbook, then we can just search for it in the study guide. Where's my study guide? No study guide. Let me open the study guide. What page? Which one is it? Number 3, eh? Should be the third one.
Yes, probably the third.
Okay, CGD, last unit, so page 40. Okay, do they talk about the inclusion here? They should somewhere. They have to give it to you. It can change. I remember before it used to be, I think it used to be 60 or 40 even, and then it's increased and increased. You're saying it's 80 now. That's a lot. Let's check.
You can actually check page 45.
Here, page 45.
So in the work, it does say 80%. So it says
Inclusion
multiply
rates.
inclusion.
Yeah, where's the inclusion rates?
And then in the table, it does say 80. Ooh, a little bit up in the table.
Up, further
And
up.
no, down. Okay, where you see multiply inclusion rate, they did times it
Ah,
by
okay, I see
80%.
it there. Okay, I didn't notice that. I thought, yeah, okay, it's right. 80% is correct. 80% is what you're using. Good. Okay, so now we've confirmed that. Okay, so 80%. All right, so this will be part of answer H. Does that make sense?
Yes.
Okay, you're going to include 1024000 plus whatever the machine is. Make sense?
Yes.
Okay, so the factory is complete. A is done, B is done, C is done, D is done, E is done. Okay, we just need to do the machine. The machine looks easy. Base cost and capital gain. Okay, so let's look at machine. All right, so here, machine BBC23 located in Polokwane was sold on the 1st of Feb. That's obviously during the year when its tax value was that. Okay, so tax value is 26. That can help me work out any recoupment. The purchaser saw an advertisement in the local newspaper for an asset that was for sale. You can assume that the adjusted proceeds is that. Okay, so we just need to assume that. That helps a lot. No recoupment calculation necessary. On the 28th of November, BBC incurred 1.6 for advertising fees and moving costs to move the asset from Pretoria. Okay, the advertising fees for moving costs were not claimed for income tax purposes. Okay, here they're just testing that cost thing. Okay, this is after CGT. Do you agree?
Yes.
So if you go to your notes, you're looking at this one. Make sense?
Yes.
Okay, so the base cost is costs minus allowable deductions. Happy with that?
Yes.
Okay, then I can copy paste. Okay, so we need to insert here. Okay. All right, let's put in the costs. Okay, so what are all my costs? Let's put them in.
The 1.6.
Where's the cost? How much did I buy this for?
They didn't tell you.
It was sold on the 1st of Feb. The purchaser sold. You can assume the adjusted proceeds is. Yeah. Okay, we're gonna need. Okay, they've only given you two figures. Yeah, the two costs. So, yeah, if we add up all the costs, so if I just put the costs in, but yeah, we need the cost price. Okay, then we need to add 1600 plus 5670. And then you've got the assessed capital loss. Okay, so there's a assessed capital loss here. So adjustment from prior year loss, this is 13,600. Happy with that?
Yes.
Okay, so it looks like the cost is not given here. That's strange. Unless it was given earlier. No, it wasn't. So you're going to have to assume that the base cost, but you see, you have to have some cost here, minus allowable deductions. What are we going to allow as deductions? What can we claim?
Not do it back? Because they did give us the adjusted proceeds and
so the adjusted
tax.
proceeds would be the recoupment, but is there recoupment here? We don't know. Let me go back to my notes. Where's my slides? Oh, I hope I didn't close it. Yeah, I didn't close it. Here's it here. Okay, so
If we
base
take out
cost, any capital allowance or deductible expenditure will not form part of the base cost. It's the historical cost. See, that's what I don't have. That's the question mark. They didn't tell you what the asset cost. That's the problem. Okay, you need to know what the historical cost is. In other words, I need to know how much I paid for the asset, because I'm going to take the base costs and I'm going to include the costs and minus the deductions. See, I'm looking at all the costs. I need the cost. I need the cost. I need the costs. There's a problem here with this question. How much did you buy this asset for? That's the question mark. They've given you tax value. Have they given you capital allowances? Then you can work backwards. No, they haven't. If the tax value is less than the proceeds, there is a recoupment. Oh, actually, maybe we can work it out. Ah, okay. I got it. Okay, I got it. I see what they did. Okay, where's my... Here. Okay, where's my adjusted proceeds? There. Copy. Paste. Okay, it's fine. I can work it out. Don't worry. I see what they did. Okay, so... do we have the tax value? Yes, we do.
Yes.
Okay, did they give you the proceeds?
Yes.
Well, yes,
Adjusted
but
proceeds.
we need to insert that here. So this is going to be 26. Okay.
I think that one is 36500.
Tax value. Ooh, sorry, I'm reading the wrong figure. Yeah. 365. Okay, that's the one. All right, we have the tax value. Okay. We have the adjusted proceeds. We have the selling price. Do we have the selling price?
No.
No. Okay, I thought we could work backwards, but we have too many unknowns. You don't have the capital allowances. You don't have the proceeds. You have the adjusted proceeds. So we don't know what the recoupment is. The tax value... Okay, hold on. The adjusted proceeds minus the tax value would be... Well, okay, if we had to work this out... Remember, let me just go back and show you this. If we're looking at the recoupment will be limited to the adjusted proceeds. So the proceeds minus the tax value. We've got the tax value in this question. We don't have the proceeds. That's the problem. Yeah, you can't work this out. There's still a problem. You need to know what this asset costs. Problem with this question, yeah. I would raise this, I would be concerned if I was the student writing this exam, because they didn't give you the cost price. Then I would have written this in the question. Okay, so if this does happen in the UNISA exam, I would show this and I would say cost price not provided, not given. Because there's an error here, there's a mistake here. Okay, they have to give that to you. You would have to know what the cost price is, because you need to know what this is. The base cost. Do you see that? It's the historical cost. That's not given. Okay, then I would write that in the actual assessment. I would say, please note that no historical cost was given. We don't know what the asset was at the initial cost price. Does it make sense?
Yes.
This is after CGT. Okay, I cannot calculate the base cost if I don't have all the costs. I've got some of them, I don't have all of them. There's a problem here. Okay, you can't work this out. All right, you need more information. Okay, if they're asking you to calculate the base costs, oh, maybe you don't even have to work it out. If they're asking you to work out the base cost, what is the base cost going to be? Oh, no, but you see, you can't work it out because we still get stuck. Okay, you still don't have all the costs. Does that make sense?
Yes.
Okay, problem. No historical costs given.
Could you not just use the cost that they have mentioned?
What costs have they mentioned?
The two, like just the advertising fees and the moving cost.
But that's got nothing to do with the cost of the asset. So how much did the machine cost? We know how much
Okay.
additional cost that you would include here. There's my 1.6 and there's my 5.67. I just need this. Then I can finish the question.
Okay.
Okay, you can't finish the question because you don't have that. Okay, do you want to assume 0? If we're going to assume the asset doesn't cost anything, then you can assume 0. But then it's not really going to do much. Then you're just going to have this minus 0, and then minus the previous loss. Maybe that's what they want you to do. I don't know. Okay, so if we do that, oh, hold on.
Yeah, if you had to add those two, the
Those two
1.6 and
amounts will be minus 1.6 minus 5.67. Okay, then you'll get that. So this minus that gives me this. Does that make sense?
yes.
Okay. And then inclusion rate, 80%. Okay, that's the only thing I can maybe think of. But then, like I said, there's a problem here. Assume no cost price, then use the other costs. Yeah, there's definitely a problem here though. Okay, that's not correct. I don't agree with that, but anyway, we'll just do it. At least you have something to work with. Okay, but there's a problem. That's the problem. Cost price, cost price, cost price. They need to tell you what it's worth. Okay. Right, that
Okay.
can happen in an exam. If it does happen in the exam, do exactly what I did here. Show that you're using the correct formula, show that you're using the correct legislation, show that you can't work it out. Tell them that you've assumed 0 and then you've done something. That's the best you can do.
Okay.
Okay, and then we'll copy this. Okay, this answer will be part of answer H. Happy with this question?
Yes.
Okay. All right, number 4. Part A, 10 marks. Okay, there's 2 parts here. What is A looking at? Your junior accounting responsibilities include calculating, okay, provisional tax. Okay, this is a nice question. Again, you're just going to use those templates. I need to open up, I think it's week, is it week 2 or week 3? Week 2, I think. Where's the provisional? No, it's week 3. Yes, there we go. Okay. Here's it. Okay, interim, provisional tax payments. All right, when you're looking at provisional tax payment number 1, that's what I need to follow. Okay, so I've got what I need. I'm just going to close these other files. Okay. All right, part A. Provisional. First and second provisional tax payments for the 2018 year of assessment and specify which date they're going to be paid on. Provide short reasons why you use the chosen basic amount for the first and second provisional tax payment. Okay, so they want the legislation as well, basically. Right, that's what they're asking you to do. Okay, so we need to determine the basic amount, calculate the normal tax, divide by 2. Okay, when you're working out the basic amount, then you need to follow all those other rules. Did I write them down here? Yes. No. This is for the second provisional tax payment. Let's go back to the textbook. Or the notes, actually. The notes will be fine. Okay, this is the other set of notes. The first one. This will be tutorial letter 2, eh? Okay. Here. Okay, we're getting there. Is this still 1 or 2? Okay, this is 2. There we go. Okay, yeah, this is what I need. No, that's for the, that's not the provisional one. That's the micro. Where's the provisional one? Here's it. Okay, right, maybe just use this because you need that information that talks about the basic amount. That's what I was looking at. Okay, they basically want you to rewrite this for the last part. Does that make sense?
Yes.
Okay, so I'm literally just going to copy paste this because that's all they want. Okay, we need to shrink this a bit, otherwise you're not going to see all of it. Okay, there's quite a lot. You need this whole bit. Okay, so they're basically asking you to just basically give that information in the actual question. So I'm just going to use it. That'll be towards the bottom of the question. Okay, because you're going to be describing stating why. State why you would choose the basic amount. Okay, so now that we've got that, let's start with that. Actually, let's draw up the... Where's my notes again? Okay, I'm just going to move this to the right so I can just type. Okay, first provisional payments. Okay, first provisional payments. Okay, I'm literally just taking this from the notes. Okay, determine the basic amounts. All right, normal tax. Divide by 2. Okay, then second provisional payments. Again, straight out of the notes. Let's find that one. Where is it? First, second. Here's the second. Okay. All right. Second payment, estimated taxable turnover. Oh, no, hold on. Here. Normal tax liability. Okay, equals second. Okay, does that make sense? Are you happy with that?
Yes.
Okay, so let's apply the basic amount first. So then here I'm going to say working. All right, so let's check. What do we have here? The basic amount is used when calculating the first and second provisional payments. The taxable income assessed by the commissioner for the preceding year of assessment. Okay, so we need to read this question. What year are we looking at for the 2018 year of assessments? Okay, so if we look at the 2018 year of assessment, we're looking at the 6-month payment and the second payment. So maybe just to draw that diagram, hold on, the diagram's not on that page, it's on this page. Here. Okay, so if I'm looking at the 2018 year of assessment, I'm looking at 6 months, 12 months. So this would be 2017, right?
Yes.
because I'm looking at that tax year for the 2018. It's always 1 year behind. So if I'm looking at the 2021, I'm looking at 2020. Yeah. Okay. Yeah, we just need to change these dates because we're looking at an older question. All right. So I'm looking at March to Feb. Okay, that's fine. All right. So okay, so now that I have those dates, now I can go back to the question. Okay, so I'm looking at March 2017. I just need to think about March 2017. Okay. All right, so let's go back. Okay, the company is not an SBC, so you're going to use the normal 28%. Okay, on the 29th of September, is this the preceding year of assessment? Yes, it is. The assessed income tax by the commissioner for the latest preceding year of assessment. So if I'm looking at 2018, the previous year of assessment will be 2017, which in this case is the 162. Does it make sense?
Yes.
Okay. Was there any capital gain here? Don't think so. No, nothing. Okay, so we don't have to worry about the capital gain. Right, the latest preceding year of assessment is deemed to be the assessment relating to the preceding year of assessment, which we've got, where notice was issued more than 14 days before the date on which the current provisional payment should be submitted to the commissioner. Okay, so when must this be submitted to the commissioner?
More than 14 days?
No, but when is this one going to be submitted? Okay, we're looking at the date the assessment was received. The date the assessment was received, this was previous years. Okay, these are years that are much longer before. Okay, but the date the assessment was received here, 24th of Feb. Do you see that?
So 4 days before.
Is it 14 days before?
No.
How many days is it? March to Feb, 21, 24.
Are we not using the 28th of Feb, or are we using the 31st of March?
Yeah, that's the problem. We need to check the dates properly. Okay, so let's go back and redo this. Okay, this diagram shows the provisional. Okay, so provisional tax means it's not relevant yet. So if I'm looking at the year end, so obviously the year end here would have been the 28th of Feb 2000. So this would have been my year of assessment. Okay, this is the previous year. This is the current year. Does that make sense?
Yes.
Okay, so this is the prior year and this is the current year. So obviously I'm going to have to pay the first provisional payment there and the second one there. Okay, so now if I'm looking at 2018, this would have been 2018.
That would have been 27.
Yeah, this would have been 2018, 2018, 2018. 2017 would have been 17,
No.
that's right. It was right.
Yeah, 7, that would be, both would have been 17.
Yeah, it was right. Okay, so now we just need to relate those dates to this question. Okay, so the first provisional tax payment will be paid on the 31st of August, 2017, and 28th of Feb, 2018. Do you agree with that?
Yes.
Okay, so let's write that down. Okay, happy with that?
Yes.
Okay, so now that we've looked at the dates, at least we've established that. Now we can make more sense of this, okay, because now we're going back in time. All right, so now that I know that I'm looking for that period, obviously the previous year would have been what?
2016.
1 March. What is the year end? Ooh, the year end is March.
First month.
So you can't use this. This year end is Feb. Do you see that?
Yes.
Okay, so you're going to have to add a month here. So it won't be August, it'll be September. Do you agree?
Yes.
And this will be March instead of Feb. Do you agree?
Yes.
Okay, yeah, so just adjust the time. March has how many 31 days, yeah. Okay, so, and then I think September has 30, if I'm not mistaken. Okay, all right, now we need to redo this. So, this would have been 1st April 2016 to 31st March 2017. Happy with that?
Yes.
Okay, now we've got the right dates. Now we can look at the question. Okay, the dates are the key here. Obviously, it won't be like this because the dates will be 2021, 2020, so it'll be easier to interpret. Okay, we need to basically go back in time and think about this question as though we were sitting back in 2018. Does that make sense?
Yes.
Okay, so if we were sitting back in 2018, our first provisional tax payment would be payable then. This would be the previous tax year. So the the taxable income assessed to the commissioner for the preceding year of assessment. The preceding year of assessment would be this. Okay, is that correct?
No,
No,
it
that's
did
not
not.
correct. Okay,
Yeah, it'd be
delete.
one.
It would have been the taxable income
19.
assessed by the commissioner for the latest preceding year of assessment. It's not yet assessed. Do you see that?
Yes.
Okay. Okay, the latest preceding year of assessment is deemed to be the assessment relating to the preceding year of assessment. So preceding year of assessment would have been that. Okay, which would have been that. That's fine. Okay. That was assessed, but it was assessed on the 28th, the 24th of Feb. Make sense?
When's our first payment?
When's our first payment? We just wrote it down. 30th of September.
Okay, so then by that date, the 1.6 million would have not been assessed.
No. The date the
So would
assessment
we
was received, but that was for 2016. Are we looking at 2016 or 2017? The year of assessment is 2017.
No, I agree with
Yeah.
that, but with provisional tax, we're only going to pay it on the 30th of September.
Yeah.
So would we not use the 1.9 million as the preceding year?
Let's read what it says here.
Because at this point in time,
The
the
latest
1.6 was not.
preceding year. Okay, I see what you're saying.
You get what I'm-
Okay. The latest preceding year would have been 2017.
But it wasn't assessed.
But then if it wasn't assessed, then you're going to be using the other one.
Because okay, in
Here,
September.
This one. Okay, so do you agree we cannot use this one?
Yes.
Because it wasn't assessed.
Yes.
Okay. So that wouldn't apply. The basic amount must be increased by 8% per annum if the date when the basic amount is calculated is more than 18 months after the preceding assessment. This means that the period from the end of the last year of assessment to the date on which the provisional payment must be made is more than 18 months. Okay, so it's not yet assessed. So if you're not using that one, you can't use the previous year. So you can't use 2017. It's not assessed. Okay. You can't use 2016. Actually, you can use 2016. 2016 is the latest preceding year of assessment is deemed to be the assessment relating to the preceding year of assessment where notice is given. Okay, that doesn't apply. We spoke about that. That was the 2017. That's fine. This one will be the 2016. So use 2016. Okay, this is greater than 18 months. So we need to provide for 8% per year. Do you see that?
Yes.
Okay.
How is it more than... Okay, get it.
Because
So
2016.
you calculating from the beginning of 2016. So from...
Yeah, it's the 2016 year of assessment.
April. Okay.
Yeah, so the 2016 year of assessment would have been at the end of 20. The 2016 year of assessment would have been February 2016. Or is it March in this question?
March?
I think it's March. Yeah, it'll be March 2016.
Okay.
Okay, so this is the current year. That's the preceding year, and that's the year before. That's 18 months. Is that okay?
Yes.
Okay. Because where are we sitting? We're sitting at the end of 2018. Does that make sense?
Yes.
That's where we're looking at. Ooh, bad drawing. Okay. There. Does that make sense?
Yes.
Okay. All right, so then I'm going to adjust this figure. What is that figure? 1920364 times basic amount must be increased by 8% per annum. So times 8% times how many years? 2 years.
Would it not be 1 year?
Let's check. No, it's more than 18 months. It's 2 years. Okay, so there's the amount. There's the basic amount. Does it make sense?
Yes.
Okay. So okay, basic amount, normal tax is 28%. Divide by 2. That's the first provisional tax payment. Happy that one?
Yes.
Okay, the second provisional tax payment will be the normal tax liability. Okay, here we have to use this.
Yes.
Where's that little bit of information? This is the basic, the other one. Here. Okay, for the taxpayer with taxable income of million or less, start with the lower of the basic amount. Okay, so let's use that. Okay, so Is this taxpayer less than or more than $1 million?
More than $1 million.
Yes. So we're going to use the estimated taxable income. Happy with that?
Yes.
Okay, the estimated taxable income is 1704320.
Yes.
Okay. Oh, I need to get the tax. Okay, let me write that down here. Less the first provisional tax payments. Gives the second. Happy with that?
Yes.
Yeah, so I think the challenge with these questions, because they're past papers, they're older assessments, you need to look at the dates. It can get quite confusing. That's why we had to draw the little picture. The picture helped, I think, yeah. Happy with that?
Yes.
Okay, so we've looked at that. We've looked at the reasons. Perfect. Okay, what is the last one looking at? Oh, this is theory. General deduction formula, section 11A. This is how they used to test it in the past when they gave theory questions. Okay, so if you have something like this, all you literally need to do, go to the notes. I think this is week 5, general deduction. There's it there. Copy. Paste. Okay, list the requirements and discuss whether the amount of 1, 2, 3, 400 is deductible by Shoes for Africa in terms of the general deduction formula of the Income Tax Act. Read with Section 23. Remember, Section 23 looks at those non-allowable deductions. Remember that.
Yes.
Okay, so Section 23 is all those non-allowable deductions like fines and so on. Okay, so literally you just need to write this down and then you just go through the question and you motivate with points. Okay, so actually incurred. Shoes for Africa is an African company that manufactures and sells shoes to leading retailers in Africa. The company has a March year during the year of assessment, so on 28 March, an invoice was received. So it was during the year of assessment. Okay, it was for 1, 2, 3, 400 pertaining to the purchase of oil. So was it actually incurred? Yes. The oil was used for the yearly lubrication of the machine used in the manufacturing process during March. Was that during the year of assessment? Yes. Is it in the production of income? What else? South Africa paid the amount per the invoice on the 10th of April. Okay, it was actually incurred, but not paid. It's still incurred though. Is in the production of income? Yes. Not of capital nature, not capital in nature. Because it's used in the machines Used in the machinery. Lubrication. Okay, you can't use machines if they're not lubricated. Otherwise, they're going to seize and they're not going to work. Laid out or expended for the purposes of a trade? Yes. So would you say yes, it's deductible, or no, it's not?
Yes, it's deductible.
Okay, nice. All right, and that's another, well, that's a past paper complete. Okay. All right, how did you find that? Did you try to do these sections or not? I'm just wondering. You said you did. That's good if you did.
No, I did not attempt this
Oh, you
part.
didn't
I
attempt
went
this
over
part.
what
Okay,
we
that's
did.
fine. All right, so you can probably attempt the part 3 and 4 if it is the same for next week for that other one.
Okay.
Okay, so I'm going to close this one. Let's open up the other paper and let's check what you did. Let's review your attempts. Let me open up. May, June. Okay, let me check my email here. Okay, I see you sent it May, June 2018. Let's save this document and let's review. Let's see how you did. Okay. May, June 2018, working, save. All right, let's open it up. Okay, how did you find this paper? Was it easy, difficult? What were your thoughts?
I can't even remember right now. I think it was okay.
Okay, not too bad. That's good. If you're saying it's not too bad, that shows good progress in terms of confidence. All right, so if we're looking at tax, let me just have a look at the question. Where's the breakdown? Next page. All right, yeah. So tax liability of a company, that's good. SBC, that's good. Okay, there's the other one. CGT, gross income provisional payments. Okay, we did those two together today. Try those two for next week and see how they go.
Okay.
Okay, we can review those two and see how you managed with that attempt. Okay, because we only covered it today in terms of revision. Hopefully it made more sense. Is that all right? Think you can manage that?
Yes.
Okay, so let's check your attempt. Question 1, let's look at the required. Calculate the income tax liability for Creamer Lights for the year of assessment 31st March. Okay, tax liability for the company, income, allowable deductions. Okay, your format looks good. I like what I see, and you've broken it up and you've shown workings. That's nice. And then they wanted the tax liability. So you needed the taxable income and then the liability. Good. Okay, that's all looking nice. Good approach. Let's check your workings. Where's the first one? Here. All right, so Creamer is a South African light manufacturing company listed in Joburg. It's manufacturing. Yeah, question?
I already know where I made a mistake by fixed assets because that's why I asked you today.
Oh, yeah, don't stress, it's fine. We're going to check all of it and see how you did. It goes much quicker now that you've looked at it because then we can just look at it and I'll confirm or adjust the workings. Then I'll send it back to you. Does that make sense?
Yes.
Okay. All right. So manufacturing warehouse in South Africa, in the south of Joburg, actually, south of Joburg, and a retail store in Sandton. Fine. Okay. Not an SBC. That's fine. Company accountant is completing taxable income. That's fine. Tax consequences, taxable income. Okay. Before taking the following into account, this is good. Okay. So you already got marks for that. I'm just going to change this into currency. Let's just use. Okay, just so we can see the numbers a bit better. Okay, that amount is correct. Fixed assets. Machine Creamer was purchased new. Okay, I do need my notes here just to make sure we're checking the legislation. Let me just quickly open up that number 6 again. Okay. All right, these are the assets here, capital allowances. It's not an SBC, so you don't use the special allowances. This is not for SBC. We might need that. Okay, I'm just going to move that to the right. Okay, machine creamer was purchased new. Okay, it's new. It's brought into use on the 1st of December. It replaced a machine that was quite second-hand. Okay, so there is a sale here. Did you do a recoupment here? Did you calculate a recoupment? We need to check. Okay, so we purchased a new asset. You've got the new machine. That's good. Brought into use on the 1st of December. Is this part of manufacturing?
Yes.
Probably. Okay, they don't specifically state that, but I would assume it was. Okay, that I would make a note. Assume a manufacturing. Okay, I would even write that in the actual answer. Okay, section 12C. Okay. Is this new? Yes. It's brought in after 2000 March. Yes. And write-off is 40%. Yes. Okay, just delete the pro rata.
Yes.
Okay. It replaced machine creamer 11, acquired secondhand on the 1st of July for 180, which broke down and was scrapped. Okay, if it's scrapped, there's obviously a scrapping allowance. Okay. Acquired secondhand on the 1st of July for that. So 180, because this is an old asset, we need to count the years. What year am I looking at? 2018. Am I looking at 2018? Yes. Okay, so this would have been the second year. So yeah, you'd still get an allowance, 20%. Okay, so I agree with this. No pro rata. Delete 20%. That's perfect. Okay, your scrapping allowance, let's check your working. Okay, you have to work out the tax value. Okay, the cost of the asset was 180 minus brackets 20% of 180 times how many years? We need to count. Okay, so brought into use 1st July 2016. So this July 2016 would have ended in March 2017. That would have been 1 year. Then March 17 to 18 is the second year, so times 2. Make sense?
Yes.
Okay, I get 108. What is the tax value? 108. What is the proceeds? 0. It was scrapped. Okay, this figure needs to change. You're working here. I see you did the pro rata again, hey?
Yes.
Okay, copy paste. Right, there's the right answer. Okay. It's a good attempt. You would have still got marks for that working. They would have marked the pro rata incorrect, but hopefully they still would have given you a half mark maybe for your cost. Yeah. Okay. Happy with that one?
Yes.
Okay, second-hand machine purchased and brought into use, based in Durban. The price was that. Creamer lights incurred transportation costs to transport the machine. Okay, again, are you assuming production here?
Yes.
Okay, so if we are, was this second-hand or new? This was second-hand.
Yes.
So 20%, August, yeah, 20% still applies. I agree with that. This is good.
So would I get all of them wrong because I did pro rata for all of it? Or would they just mark me wrong? Okay.
Yeah, they'd probably penalize you for that. It's a pity, but yeah. Remember, you just need to follow the legislation. So now that you know that, don't make that mistake again, hey?
Yeah, definitely.
Yeah, no apportionment. Yeah, you would have got those wrong, actually. Yeah, it's quite a lot to lose in terms of marks because they gave you so many of them.
Yes.
Okay, yeah, it's a pity because they gave you so many. Normally they don't give you so many. I mean, if they give you one, that's good enough. But it looks like they're testing this a lot, which is fine because it can be easy marks. Okay. Next one, shop fittings. Okay, fittings were moved. Oh, hold
Can
on,
you
the
go?
costs. Yeah, the
Yes,
costs. I see you didn't put the costs in, eh? Creamer incurred
I did.
transportation costs. Transportation cost to transport the machine. That would be a normal Section 11A deduction. Why haven't you put it in?
I did where that. If you
Where?
see it's a quotation
Oh,
on.
I see it. Okay. What did
Would
you
I
do
pro
though?
rata?
Creamer incurred transportation costs of 18,000 to transport the machine. Why did you divide by 5?
Oh, because we would write it off over 5 years.
Yeah, but you don't write off transportation costs. Transportation cost isn't a non-current asset.
Oh, okay.
Okay, it's just a normal Section 11A deduction.
So you would write off the whole thing.
Yeah, you'd write off the whole thing because it was bought and it was transported to the store.
Because I did see somewhere, I think I watched one of the videos on Unisa, and she, if I'm not mistaken, divided it by 5.
Because maybe they're capitalizing the costs. All right, so you can capitalize the cost, then it's included in the historical costs of the asset. Does that make sense?
So when would I do that?
Well, let's read this again. The second-hand machine purchased and brought into use on the 1st of August from suppliers based in Durban. The purchase price was that, and Creamer incurred costs to transport the machine to Joburg. Okay, yeah, you're buying the machine, so it would be capital in nature. So if it's capital in nature, then you would apply the 20% to it. Okay, you wouldn't divide by 5 though, because this is part of the cost of the asset.
Okay.
What is it? Was this second hand? Yeah.
Yeah.
Okay, there's the correction. Okay, it's
So
capital in nature because it's part of the historical cost.
do I ever pro rata?
If it was Section 11E, Section 11E wear and tear allowance, you pro rata.
Okay.
Okay, so yeah, just check that video. If it's a video, it's probably because it's 11E. Wear and tear pro rata. Capital nature, Section 12C, no pro rata.
Okay.
Okay, some shop fittings were moved on the 1st of December from the retail store to the manufacturing warehouse to be used in the small office. Moving costs of 16 were incurred on this date. These shop fittings were purchased for 160,000 and brought into use on the 1st of April. The wear and tear allowances for the 2018 year of assessment related to these shop fittings must still be taken into account. See, here we go. This is a Section 11E deduction. Make sense?
Yes.
Okay, this was for shop fittings purchased for 160,000 brought into use. Let's go look at our Section 11 deductions. Is this manufacturing? No. Yeah, 11E is the right deduction. Other assets, other movable assets. Right, did they give you the time here? They should have. Shop fittings, they did. Divide by 6 is good. Yeah, happy with that. Okay, but we need to pro rata for this, eh? Okay, so the shop fittings were moved on the 1st of December for the retail store. Okay, moving costs of 16,000 were incurred at this date. Okay, if the moving costs were incurred in this date, there's no pro rata. I don't know why you're doing this. Okay, it's just a normal 11 deduction. No? 11A. Okay, this is a moving cost. This is the cost of doing business.
Oh my word. Okay, wait.
16,000 was incurred on this date, and that was to move the shop fittings. So the shop fittings is a capital asset. Okay, the operational cost would come out as is. Okay.
The reason that's something I did watch the Unisa video, and that's what she did. I can send it to you. That
Shop
makes it
fittings
better.
were moved on the 1st of December from the retail store to the manufacturing warehouse to be used in a small office. Moving costs of 16 were incurred at this date, and these shop fittings were purchased for 160,000 brought into use. Okay, again, if we're looking at it in terms of capital, let's see what the textbook says about this. Is moving cost capital in nature or not? The costs of acquiring, creating, or improving the asset are part of the base costs. Actual costs, transaction costs, moving costs. Okay, there we go. There's the confirmation. All right, it is part of the base costs. Okay, so if it's not operational, so moving costs for other things. Let's put a note here. Operational cost, section 11A for transporting. Anything else not capital in nature. Okay. Part of the base cost. Right, so if we're reading this question, then it would be better to assume that because it's obviously related to the asset. Okay, moving costs. Okay, it's good we checked that. Yeah, that's something that I would have overlooked. Okay, because I would have assumed that this was part of day-to-day operations. But if it's incurred specifically for the assets, if it's the shop fittings that you're moving, then that's fine. Then it's part of the capital in nature. All right, so if it's capital in nature, shop fittings, what was it? 6 years.
But see, the problem with the 6 years is that you did not, how can I put it? You didn't really pay for it in the previous 2 years because this was acquired
Okay,
in,
this was
I'll tell you now,
bought when?
in 2015.
2015, yes. So
So you
2015,
6 years.
so how many months is that in total? 6
So
years
I
is,
got
6 years is how many months? 240 months.
no 6 years is 72
Ooh.
months.
16%? Not 16%. 16,000. Okay, so I've got a 6-year asset. $72 months. Okay, we brought this into use on the 1st of April.
Yes, 2015.
How many months is that? April to April is 12. So that's what? April, May, June, July, August, September, October, November. 12 plus 12 is 24. 24 plus 8 is 32. So there are 40 months remaining.
Yes, that's how
Okay.
I worked it out.
All right.
So that's why I divided by 40 and then I times it by 4.
Let's see. December, January, February, March. 4 months. Yeah, that's fine. It's correct. I agree with that. Okay, did you get that figure?
Yes.
Okay.
So would I not do that for the machinery that was bought before? Like the previous one where it says transportation on secondhand machinery?
No, because that's the Section 12C again, hey?
Okay. Okay.
That's a
So only if it,
manufacturing asset. It's capital in nature. It's not a movable asset. It's an immovable asset. Because
okay,
the
got
machinery
it.
must be installed.
Okay.
Yeah, this is 11E.
Okay.
Okay, so that's fine. That I agree with. That's the working there. That's good. Okay, what else do you have here? Was that it? Yeah. No. Yeah, that was it. Because we looked at that. We looked at that. That's perfect. Okay, the printer. What was the time? 3 years.
Yes.
Okay, so the printer was brought into use on the 1st of May. Is that the beginning of the year?
No.
No. Okay, because it's end of March. So you don't count April. So it's 11 over 12, which is fine. Yeah, that's correct. Divide by 3 times 11 over 12. Yeah, this is perfect. Happy with that. Retail store is situated in a 4-story building in the heart of Sandton. Creamer Lights purchased one of these stores from a developer. Okay, this is your capital allowances looking at buildings. So let's go get that. Okay. 1st of April 2013. This is a retail store. So if it's a retail store, it's commercial. So it would be 5% non-apportioned for the purposes of a trade. After 2007, it is, yeah, so 5%. Did you use 5%?
Yes.
Perfect.
Yes, I did. Okay.
Okay, let's just put in the section 13.1. 5%, yeah, looks right. Okay, inventory, raw material purchased during the year. That's normal section 11A. Raw material deductible, that's fine. Yeah, I know you're putting these in red, so they're minus figures. Yeah, so as long as you're just not summing up at the end. Did you just sum up at the end? No, you did subtract. Yeah, that's good. That's fine. Okay, I'm just looking at your formula. Okay, so raw material, happy with that. Closing stock on hand. Closing stock, you subtract closing stock from cost of sales, so you make that less. Cost of sales is a deduction, so you would have to add it back. Okay, you did add, that's good. All right, you're looking at closing stock on hand, cost price, and market value. Okay, be careful. You need to use the lower of cost and market value. So, okay, just be careful with this. It's probably right, but you need to state these things in the exam, hey?
Okay.
And I would show each one separately. I wouldn't show it as one. So I would show it as 2 separate calculations. I would say raw material cost was 230,400. Okay, which you used. Okay, which is fine. And then finished goods. Yeah, because remember, if you don't show them that, they won't know if you applied the theory correct. And they might even give marks for that. That's why I'm always putting in these sections as well, because you never know. I know at other institutions, so when I did this at WITS, they used to give us marks for these things, eh? But it used to be closed book. Obviously, things have changed. It's COVID and it's online. So now you have open book. So I don't know if they're still going to give you marks for that. Maybe, maybe not. But show it just in case. It's always
Okay.
worthwhile doing it. Okay, because it shows your thought process. Okay. Does that make sense?
Yes.
Yeah, so your answer's correct, but just show the workings. All right. March 20, some lights in the restore with the market value 15 and a cost of that were sold to staff members for 3,000. Okay. Obviously, if you are selling goods to the staff members, that's drawings. I think it's a section 23 non-deductible. Okay. What else do we need to look at? On the 28th of March, some lights in the retail store with the market value. Okay, are we selling lights?
Yes.
Okay, be careful. Then you need to adjust your stock. So this was part of your closing stock. Do you agree? So this is correct. You can't deduct the sale. You can't include the sale. Actually, where's your income? Here. We need to show that as well. And then you've got lights that had a market value. This is going to come out of your closing stock. Because this was on the 31st of March. Oh, okay. It's actually fine. Because 31st March is after they would have taken it. Do you agree?
Yes.
Okay, so this would have been fine. So you don't have to adjust it, okay, because the date is important. All right, so this is just a date that we need to consider in terms of the sale. Okay, so you cannot claim that. It's not allowable. Okay, so that's fine. Opening stock has already been accounted for by the accountant. Then you don't have to show it. You would have subtracted. Do you agree?
Yes.
Okay. Right.
I also, okay, going to research and development, and I know I made a mistake when it came to the machine. Instead of 50, I used 150.
Okay,
So I know
it's
I made
fine.
that mistake.
Yeah, don't worry, we can
Okay.
check. Okay, R&D expenditure was incurred with regard to the development of the new environmentally friendly light. Expenses incurred during the 2018 year of assessment related to the creation and development of the product. Other expenditure was that incurred to purchase the new machine, which is used solely for the creation and development of the product. The machine was purchased and brought into use. Okay. Yeah, this you need to go to the textbook. Page 99. Here's it here. Okay, so research and development on behalf of taxpayer. The taxpayer qualifies for deduction of 150 of the research and development if research and development was approved by the minister. Was it approved by the minister?
Yes.
Doesn't say so.
Oh,
here at the bottom, next page. I see it. The necessary approval from the Minister of Finance were obtained before any of the research. Yeah, so it was. Okay, I'm looking at the next page. Yeah. Okay, so it was approved. So 150,000 would be applicable, and that would apply expenditure incurred in respect of research and development carried out by the taxpayer. Yes. Yes. The amount is allowable to exempt from tax. The company that carries on the R&D 150%. Oh. The amount is allowed to the extent that the other person that carries on. Okay, this is something else. Okay, we just need to look at the expenditure. The expenditure is 150%. That's fine. The capital nature bit, we need to look at this. No deduction may be allowed in respect of immovable property. Okay, that's plants. Okay, here. Where the research and development is approved, where the expenditure is incurred on or after the date. Okay, that's fine. 150% of the research and development, that's fine. Okay, I don't see anything here about the... We need to look at this maybe. Developing, yes. Okay, yeah, the property. The property. Do you remember where the property fell under? Was it here, I think?
E, if I'm not mistaken.
Here's it here. Looks like it.
Yes. Because in the
11D.
second part,
This means that Section 11E, 12C, or 13C assets will not obtain a Section 11D deduction. What does Section 11D say? Note that where an asset is immovable machinery, plant, utensils, articles, the asset cannot obtain a... Okay, there we go. Yeah, that's correct. All right, so now we can answer the question. All right, so do you have the expenses? What were the expenses? 876 times 150. Perfect, that's correct. Other expenditure, ooh, identify it. Okay, capital allowances. All right, is this the mistake that you picked up?
yes. So
Okay.
that's the
Is this part of manufacturing? Yes, it's producing the product. So if we go back to section 12C, was this new? Yes, it was. So 40%. Happy with that?
no, I think it's 50%. If you go to the textbook on the page that you are on,
I'm looking at section 12C.
okay, wait. Look at the example that they gave you there. They said, for example,
Oh,
new
okay,
or
okay, okay.
unused.
Yes, because this is for research and development. You're right. Okay, if it qualifies as R and D, then you don't apply this. I was looking at that. Yeah, so you get an extra additional. I think we even did this last week. It's correct. Yeah, it's right. Okay, 50% in the first year, 50, 30, 30. Do I have this in the notes?
Um,
Okay, I've got this in the notes, but it's for an SBC. There's it there. I want to add this in the notes then. This looks like it's something different. I don't think I've got anything in the notes about this. Yeah, I don't. I want to add it. Okay, so let's go to this page here. Was it 50, 30, 20, hey?
yes.
Yeah, that's right. Okay, good. Also applies to the improvements. Yeah, that might have been new. That's probably why it's not part of the notes. Okay, let's save that. That's a good addition. All right, perfect. So, times 50. Times 50. Happy with that?
Yes.
Okay, let's see what else you did. Other, restraint of trade. Okay, we spoke about the restraint of trade. Also, you need to show those workings, hey?
Okay. So it's the lower of 3 years.
Yeah, I'm going to just go and copy paste what we did last week because we wrote it down so nicely. October, November 2018. It's the same thing. I just want to get the workings here. We're going to have to add more lines. Ooh. Too many. Okay, happy with that?
Yes.
All right, so the restraint of trade was 700,000. And 1/3 of it. Okay, happy with that. Hold on. Oh, okay. Hold on. I see you've got 2 years and 6 months. We need to make this 2.5 years. Do you see that?
Yes.
Okay, so 2.5 years. So 2.5 will be 280,000. It's still the same answer though. Okay, the light design was acquired from a famous Italian light designer for that. Okay, this is those purchased patent stuff, the copyright stuff, the design stuff. Okay, also very specific. You need to go look at that. Copyrights or design. Let's just type in design. It's a design actually. Okay, there's the design. Okay, so this is the GB, I think. Yeah, the GB, GC stuff. Yeah, okay, here. Acquisition of patents, copyrights. Okay, so what type of patent was this? It was from a designer defined by the Designs Act. Okay, so it is a design. It was registered 2 days later at a cost of 3.5. Okay, and it was acquired for that purchase price. Okay, fine. All right, so is it any design designed by the Design Act? Yes, it is. Okay, so we are going to apply Section 11G. All right, if the expenditure is less than or equal 5,000, you can deduct in full. It's more than that. It's more than 5,000, so then it's 5% per annum if the expenditure is in the copyright, including knowledge or rights. It'll be 10%. So did you use 10%?
No.
Okay, purchase, where is it? Here. Oh no, you didn't even include it.
No, I think I think you're on the wrong one. You're looking at October, November.
Oh, yeah. Sorry, close that. Save this. Okay. All right,
The
new
new design.
design. Yes. Okay, we need to show workings here.
So I just need to do the 10%.
Section 11 GC. Okay, this was okay, if the expenditure is less than or equals 5,000. All right, so remember you've got two things here, hey? You've got the cost and you've got the, do they split it? Let's just check. No, they don't split it. It just looks like all the expenditure. All right, so there's no split. I don't see any split here. Here, Section 11 GC, deduction in respect of expenditure actually incurred in registration. It is split. Registration of design. Okay, so you do have to split it. So GB is for the registration. GC is for the patent. Do you see that?
Yes.
It was 10%, hey? 10%, yes. Okay, can I just group them as one? So that at least your formulas don't get thrown out? Is that okay?
Yes.
It's 3,500.
Oh, yeah, I was just about to ask. Okay.
Okay, let's just read it again. 3,500, 10%, yeah. Okay, creamer lights paid outstanding penalties and interest. That's not allowed. Null, good. Section 23. Okay, then the donation is the last line. Yes. Okay, the donation, you need to do a total column. Okay, you forgot to do the total. Okay, because it's limited to 10% of. Okay, so right, let's go to the top. This minus 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 plus minus 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 minus. Okay, gives you that figure. Okay, so donation limited to 10% of. If I divide that by 10, I'll get 280631,944. Does that make sense?
Yes.
Okay, what was your donation? 120,000, so fully deductible. Okay, this is incorrect, obviously because we updated the workings. Happy with that?
Yes. Yes.
Good effort. That's a really good answer. And then we just need to fix here. Income before capital gain, zero capital gain. Yeah, that's very good. Okay, it's a decrease. Is that referencing correctly? Yeah. Oh, hold on. No, it's not. Okay, let's just do it properly. Minus that. Okay, yeah, it looks like the same actually. Okay, 0 there, and then times that by 28%. Yeah. Okay, nice. That's looking good, eh? Okay, was that it? Did you only do the one? Cheryl, was it just that one?
Yes.
Ooh, the connection was a bit slow there. I didn't quite hear that. Are you still there?
Yes, I need to do the other one.
Oh,
I'll do it
okay.
today.
Okay. How
I
much
only did
time?
question 1. I'll complete it
Yeah.
today.
All right. Can you do those last
Can you
3
hear
for
me?
next week? Can you do those last 3 for next week? Will that be okay?
Yes.
All right. So try this one. Do that one for next week. See how that
Yes.
goes. I can review it as well. And now because we've covered all the CGT as well as the provisional, you should be able to do the last 2 as well. Okay, good practice. Oh, it even looks like the same as what I just did. Very similar. I like how they break it up. It's very good. Instead of just one long question. Because students forget about all these steps and then they miss so many things. Okay, you have to do it using all those steps and then it'll be perfect. Okay. Happy with that?
Yes.
Okay.